All right, you're welcome, guys. This is our second class, and then we wanted to basically prepare ourselves for the new year. And the first class we had was on trade planning, how you need to trade, how you need to plan your trades. All right. So if you haven't seen that video, I will posted it in the group already. Okay, probably I'll post it again. So we did a class on training, how to plan your trades, right? From risk management, to strategy, everything. We even shared a spreadsheet that helps you organize all this and have basically a clear picture of exactly how this should be done. We share that spreadsheet. Okay, so now today we're talking about market outlook for 2023. Market outlook for 2023. So understanding what the market is going to do, what is likely to be like for the market in 2023 is so important, right? Sometimes as a retail trader, you may think, oh, probably I don't need so much to know about the whole world, what is happening, what the market is going to do for the whole year. I just need to know how to take 10 pips and 20 pips and all that. That's what I need to know, right? That's the way you want to think. That's the way that's the way some people might think as retail traders. But hey, the market, I always say to people that when you come into the market, you are following the money. The goal is follow the money. There are different kinds of traders. There are two broad kinds of traders in the market. There are the retail traders and the institutional traders. The retail traders and the institutional traders. So the retail traders follow what the institutional traders are doing. Yeah, good evening. So the retail traders follow the market, follow what the institutional traders are doing, right? So you want to be able to know what is the big money in this market? Where is it going? What is it doing? That's where you want to follow. If you go to the market right now, there's a news event that was released today, non-farm payroll. The US dollar is basically collapsing right now. If you are selling USD JPY now, you are making a lot of money. If you are buying Euro USD now, you are making a lot of money. If you are selling gold now, if you are buying gold now, you're making money. If you are buying GBP USD now, you're making money, right? So this is the reason why, as retail traders, you want to understand where the institutional money is going. What is the major move in the markets? What is the major move in the market? That's what you want to understand. That's the reason why you need to understand what the market outlook is like. For this year, this is what institutional investors are looking at, and you as a retail trader, that's what you should be looking at too. You may not trade with it fully, but of course you want to know what's going on. Now, there's a fundamental news comes out. The fundamental news comes out and it moves the market in a particular direction. Why do you think that happens? And you see 200, 300 pips within a few hours. The market will normally not move like that, but now you see it moving heavily like that. Why do you think that's happening? That's where institutional money is flowing. That's why you're seeing those massive moves. Okay, if you're in the market right now, just as I speak right now, you can just pick your phone and check. You will see the movement in the market just from non-farm payroll that was released about maybe 3 hours or so ago, right? 3 hours plus ago. What's happening? The market, that's institutional money. So as retail traders, what we do is we follow the money. We follow the direction of the market. You would have heard that the trend is your friend. Okay, the trend is your friend. What does that mean? That's where the money is flowing. If you trade against that trend, you get crushed. The trend, where the money is going, is the trend. This is the reason why you want to understand what is the market outlook for the year. What are we expecting this year? Now, it's not going to play out all at once. It's going to play out in bits and pieces. It's going to play out from one month to the other. But basically, what are the institutional monies, the institutional investors, people who are trading billions of dollars, who are moving billions, what are they looking at in this market? What's their expectation for this year? And you as a retail trader, you need to be aware about that. That's the reason why we decided this class is very important that we're going to do it. Okay? So I want you to, first of all, to make you understand, because a lot of the things we're going to talk about, it may not look like, oh, buy and sell in the market. Oh, let's trade Euro USD. That's not what we are going to talk about today. But some of you might be like, oh, by the time we're going on, you might be like, oh, do I need to know this? That's why I'm explaining to you right now why you want to know. This is what institutional investors are looking at. This is what JP Morgan, Morgan Stanley, World Bank, this is what they are looking at. You as a retail trader, it's important that you also know what these institutional investors, where the money is flowing, well, what are they looking at? What are they expecting from the market this year? So that you also know how to play whenever these events are unfolding, because these events don't unfold at once, they unfold gradually. They unfold from week to week, from month to month, and so on and so forth. All right. So that's the background for this. That's what I want you to first of all understand why this market outlook is so important. Okay. So let's get into it. Okay. So first and foremost, let's back up to last year, okay? Or let's back up to last year, then we'll even back up to much longer than that. Now, last year, Russian invasion happened on the 24th of February. Russia took its artillery and weapons and went into Ukraine and decided to, a free country, Russia decided to invade a free country. Okay, Russia decided to invade a free country. And so, but something to note about Russia and Ukraine is this, and the war has continued till now. The war is about a year right now, and it's still continuing till now. So there are some things we need to understand about the Russia-Ukraine war, right? Number one, Russia's energy export dependence. The whole of Europe, almost the whole of Europe, depended on Russian oil and gas. Almost the whole of Europe depended on Russian oil and gas up until that time, and even up until recently. Right? This was how Russia was making all these monies and funding and stacking up the reserves that they are spending, that they initially started spending on financing the war and the rest. All of that is very, very important. Now, the thing with the oil market is this: whenever there is an increase in supply and demand remains the same, what happens is that price is going to fall. The forces of supply and demand work so well with all markets. All markets respond very well with the forces of supply and demand, right? Any market that has a substantial amount of users, a substantial amount of people patronizing that market will respond to supply and demand dynamics, right? So now, when you when Russia invaded Ukraine, what happened was that the West, United States and Europe and the rest began to sanction Russia. When they sanctioned Russia, what that means also was that they would sanction Russian oil. Sanctioning Russian oil meant that Russia began to have restrictions to its flow of oil. Remember that Russia is one of the major, I think the second largest producer of oil in the world, second or third largest producer of crude oil in the world. Now, when you see that for a country that's pumping 9-10 million barrels of oil into the world every day, by the time you remove that supply, what happens to price? Price is going to go through the roof. Price will shoot up. So when price shoots up, what is going to happen to all the people who are who are consuming that oil? Whether you are buying from Russia or you're not buying from Russia, the price of oil is one market. The price of these goods is one market. So your own, even though you're not buying from Russia, because Russia's supply is affected and we are dealing with one market, what you discover is that your own price will rise. So I'm trying to paint, I'm building a background towards where we are going, right? Just follow. I'm building a background towards where we're going. Then number two, you find out that Ukraine was a food dominant exporter. Ukraine exported a lot of grains, a lot of fertilizers, a lot of grains to the rest of the world, to the US, to Africa, to different places, to Europe. You see, now when war started, there is no way you can produce and export food when bullets are flying over your head. So these are the things that led to, if some of you are listening right now, you will know that there's a lot of issues around the world. You will know that even in the UK right now, lots of challenges are there. Inflation, energy costs, energy prices are rising, food prices are rising. People are suffering in the UK right now, to be frank with you, right? And not just the UK, and several parts of Europe and so on. So I'm trying to show you, this is how it started. So Ukraine's pushing food into the global market was stalled because of Russia-Ukraine war. So now when you see that the oil supply of Russia was curtailed, what that did was increase energy costs. Price of oil rose. And remember, most of the world is powered by oil and gas. Most of the world is powered by fossil fuel. The same oil and gas that have been drilled from the ground for decades is still the same thing that's powering most of the world, including advanced countries that are saying, oh, we want to go green. We want electric power, electric cars, and all of that. The fraction of the economy that is powered by hydro, by solar, is very infinitesimal, very small, even in the US, in Europe, and the rest of them. Very small. Most houses, most energy is generated and powered by gas and crude oil, the same gas and crude oil that we've always known. So now when Russia, a major supplier of oil, even a country like Nigeria, if the supply of oil from Nigeria is significantly affected, it will affect the rest of the world, because at least maybe 1 million barrels or so is coming from there. You see, so now for Russia, you can imagine the effect that had on the world in terms of cost to majorly those that depend on Russian oil, which is Europe. Okay, so let's go on. Then the next thing was COVID. We know that during COVID, the world was literally shut down. Everywhere was shut down during COVID. Okay, so everybody went, economies were shut down, manufacturing facilities were closed, all kinds of businesses were closing down. People were forced to lock themselves up in their houses. Then for countries like America, we're going to be talking a lot about America and the West, because those are where the big investors are. Those are where the markets that we trade. We don't even trade local currencies, apart from South Africa. Apart from South Africa, there's no real strong currency in Africa that's being traded. If you're trading South African rand, USD, SAR, ZAR, which is USD South African rand, that's basically a good currency. There are people that trade that, and it's very volatile. You can make money from it. But besides South African rand, there's no other currency in Africa that is traded globally, right? So that's the reason why we're mostly going to be talking about the West. We're going to be talking about the United States, Europe, and all of the things that's happening, especially in the US and Europe, Australia, and the rest of them, the developed countries. That's what because that's what determines what we are trading. That's how we make money. If you're trading Naira and dollar, you will not make money from that. But if you're trading USD, JPY, you make money from that. Right? So that's why we're going to be focusing more on what happens in the West. Americans were awash with stimulus checks. Now, the government of the US basically printed trillions of dollars and handed it out to people. Now, watch this. Something is happening here. Everybody need to stay at home. People need to pay bills. People need to pay their house rent, right? Their house rent, because the landlords were still collecting money. People need to feed themselves. A lot of things need to continue, right? So America and people were not working because they had to stay at home. So what the government printed money, literally printed money, turned on the printing press. The Federal Reserve is the central bank of the US. They are the ones that are responsible for this kind of things. Okay, it's called monetary policy. So they literally, it's called fiscal policy. They literally opened the printing press, printed trillions of dollars, and started sending them out to people, from the last president to the current president. That's how they did it. And the goal was, let us get America back again. Let us get America back again. Let us stimulate the economy. Let people be able to spend. Let people be able to be confident in their livelihoods and be able to spend. So what happened was the economy rebounded very quickly. The economy recovered very quickly. A lot of jobs started getting created. People started spending money because they had money. Some even had monies to invest in crypto and the rest of them. That was the time that crypto was rising. As in, Bitcoin was just rising. Bitcoin went over $60,000. It was during that period. All these monies was coming from the government. They were giving monies to people who needed it, people who didn't need it. Up till now, even in the state of California, some people are still getting those stimulus checks till today. In fact, sometimes in some cases, they are handing those checks to people who make hundreds of thousands of dollars a year. They are still giving them checks, right? Free money. And what happens is that when you hand out money to people like that, what happens is that there is a lot of money and the goods that are in the market remains the same. So demand goes through the roof. When demand goes through the roof, what happens? Let's go to the next one. Pent-up demand from COVID. Please mute yourself, thank you. So pent-up demand from COVID. Factories shut down, leading to supply chain disruptions. So now, because factories were closed, and people needed to, a lot of the goods and service goods that are consumed in the United States are not produced in America. They are produced in Asia, in China, in Vietnam, and all of these places, right? In Thailand. These are the places where they produce the goods that are consumed in the US because of low cost of labor in those places. But here is what happened. Because the whole world was shutting down, even manufacturers in these countries in Asia also needed to shut down. They thought, oh, they won't be able to, there's no way demand can be high because everybody's shutting down. How are people going? Because if people are not making money and they are forced to stay at home, where would they get all the money to spend? But they did not anticipate that the government was going to be printing money and handing out monies to people. So what happened now was people were having a lot of money and staying at home and ordering products. But the products were not coming because the manufacturers did not know that there was going to be demand. So what happened was, and then for every product that you see sitting on the shelves, wherever you are, South Africa, Nigeria, America, every product you see, let's say an Apple AirPod that you want to buy, it is said that it takes the supply chain to get an Apple AirPod from production to the shelf where you can buy. It takes about 6 months. It takes about 6 months. So what happens when something happens to break that chain? Let's say there's no production happening at a certain time for any reason. In this case, because of COVID, there was now pent-up demand. There was now so much demand and no supply. That's what causes disruption in supply chains, where people started, and all of these things started causing price hikes. It's like a lot of money started chasing so few goods. There was a time in the US during COVID where there was no tissue paper, no toilet paper anymore in the shopping malls. Recently, there was shortage of baby food, right? So all of these things led to increase in costs. So now we are discussing increase in cost of food, increase in cost of energy, increase in cost of goods generally. So this is leading us somewhere, right? This is leading us somewhere. This is leading us to what happened last year and what's going to go on to happen this year. We're talking about outlook. And we are basically laying the foundation to know where we are coming from so we know where we are going, right? So goods inflation, all of this happened. If you follow me now, you understand how prices of goods began to skyrocket. Number one, it started from the Russia-Ukraine war, because those guys export a lot of energy, a lot of food. Disruptions happen during war. The price will go up because people are still going to eat. Even though you are fighting, where the places where Ukraine used to move export food to, they will still have to eat. So what's going to happen? Demand is low, supply is high, price is going to rise, That's exactly what happened here. Okay, so let's go on. Then, when price, like I said earlier, when as the Federal Reserve of the US handed out trillions of dollars to citizens, people started spending money. And what happens is that by the time you factor in all these issues of Ukraine war, you factor in supply chain during COVID and all of those things, you discover that the price of goods cannot but rise. There's no way, because there's so much money chasing so few goods. That's what they call cost push inflation, right? So that's what that's inflation. Definitely that inflation is caused by so much money chasing so few goods. That's just the way it works. Even if it's transport, you're taking a bus, and then at that point there's a crowd and there's only a few buses. The buses can jack up their prices at that time, and people will not even think, they will still go for it. But they won't do it if the buses are everywhere. That's just transport. Not to talk of food, which literally it powers people's lives, right? So basically, that is what it is. Please put off your video. Put off your video. Thank you. Okay, so let's go on. So this inflation, prices of everything started to rise. And watch this. The Federal Reserve of the United States, just like every central bank in the world, has two major mandates. I call it the Fed's dual mandates. Okay. Now, these Fed's dual mandates, there are two. Number one, stabilize prices. Stabilize prices is the number one mandate they have. So they have two mandates. Number one is to stabilize prices. The second thing is make sure to ensure full employment. Full employment. The goal is ensure full employment. Now, the first one is stabilize prices, and that means if inflation is running so high, the prices are not stable. It's going to make the economy unstable. So what the Federal Reserve has to do is that they have to do something about it. So rate hikes slows down the economy. So what they have to do is this. If inflation is so high, the jobs are everywhere, and the cost of goods are so high, which is inflation, that if it is left unchecked, it is going to cause destabilization of the economy. It will cause the economy to be unstable. Now you can see, for example, what inflation did to countries like Zimbabwe, where people needed to, at a point, until Zimbabwe had to abandon their dollar and started using the American dollar, where you will need trillions of dollars of Zimbabwean dollars to buy a loaf of bread, right? You will have to wheel money in a wheelbarrow to go and buy something. The money became useless. That's what inflation does. That's the reason why serious central banks fight inflation with everything they have. They fight inflation. In fact, inflation nearly collapsed American economy in the 70s. Inflation left to rise unchecked, almost destroyed the American economy in the 70s, until they brought a particular Federal Reserve chairman called Paul Volcker. Paul Volcker literally helped restore America by taking care of inflation, right? So that's the dual mandate. The first one is take care of prices, make sure inflation doesn't go out of hand, make sure inflation remains somewhere around 2% or so. That's why the goal of the Federal Reserve and serious central banks around the world is to keep inflation around 2%. Inflation also destroys Venezuela. Venezuela used to be one of the best economies in that region, in its own region, in the 70s. The same Venezuela now that is ridden with sanctions, they can't even do something with the oil that they have. That's how bad inflation can be, right? So that's why any serious central bank does not joke with inflation. So what they have to do is this. They have to basically pull the economy down, literally cool the economy down in order to bring down inflation. And the way they do that is by increasing interest rates. So what's the interest rate? Interest rate is the interest you pay interest rate is the interest you pay when you borrow from a bank. And if you borrow from the bank, whether you're borrowing directly from the bank, or you are borrowing like personal loans, or you are taking a loan as a business, or you are taking a loan to buy a house, in the case of that's mortgage, a personal loan, business loan, whatever loan you're taking from the bank, there's an interest you pay to the bank. So in addition to repaying the loan, right? So let's say in a year you borrow $100,000, rands, whatever amount or whatever number, you borrow 100,000. Let's say they are telling you in a year you should pay 10%. That 10% is the interest rates that you're paying. But that 10%, you have to understand, is set by the central bank of the country. It's set by the central bank. Basically, the interest rate the central bank sets determines how much the bank is going to charge you. So if the central bank sets an interest rate of 10%, for example, and say, hey, the baseline interest rate is 10%, it means that if you go to the bank to borrow money, it means that the bank is going to have to charge you 10% plus, because they're also going to make money. If they charge 10%, that's the baseline. That's the central bank rate. They have to put their own interest on that in order to make profit. So they may not charge you 15%, 18%. That's the amount that they are putting on top of the 10%, which is the baseline inflation number. And remember, now imagine that central bank reduces that interest rate to 5%. It means that the interest that you as a customer or the consumer is paying will also reduce. That's how inflation eats into the pocket of individuals. You may not know what the central bank is doing when they set interest rates, but whatever they are doing is affecting how much money you have in your pockets. And the way they control the money you have in your pocket is by interest rates. It's either they increase it or they reduce it. They increase it when inflation is high, when the economy is so hot and there's a lot of inflation. They increase the interest rate so as to draw a lot of money out of people's pockets and to make it difficult for you to buy and spend money. But when the economy is not doing well, what they do is they decrease the interest rates so that people can have low interest rates in order to borrow money. All right. So if you imagine if you want to buy a car and they tell you that this car, to finance this car is 5% a year, and then another person says to finance this car is 10% a year, you know how much that is going to amount to. The difference between 5 and 10%, how much that's going to amount to in cost out of your pocket in the course of 1 year. So this is how the Federal Reserve and the central banks control individuals, control what you control, basically the money that's in your pocket and how much you are able to consume and how much you are able to spend. So what this Federal Reserve started to doing, because of all this interest rate high, because of all this inflation that has come from Russia-Ukraine war, came from COVID issues and all of that, the way they started to control it is by increasing interest rates. They basically raised interest rate that was zero. It was kept at zero during COVID in order to be able to stimulate the economy and make everybody be able to have access to money. But now, because inflation is going high, they had to increase the interest rates in order to make it difficult for people to borrow. You see, so inflation rate high slowed down the economy in order to slow down inflation. Until inflation falls, the Fed keeps hiking rates. Right now, throughout last year, the Federal Reserve just kept hiking rates, just kept increasing interest rates. You will see, guys, how this plays into what we are into how your trade happens. That's why I say, for those who just came in, you may not understand. I said this at the beginning. Okay, this is not about buy and sell. What this class is all about. This class is about understanding macro. This is called macro, understanding the outlook for the year so that you will know what institutional and investors are looking at, so that you as a retail trader, you will also know what to look for. When you see, I used an example of the non-farm payroll that came out this afternoon, and then how the market is reacting. What's making the market react like that? It's not retail traders, it's institutional traders. So you need to look at what institutional traders are looking at so that you'll be able to make the kind of money they are making. Because what we do as retail traders is we follow the money. We follow the money. Okay, so I'm just reiterating that for those who came in a little bit late, who don't understand why we are talking about what we are talking about, because this is very, very important. And then at the end of the day, at the end of this session, you will see how this ties into what you are trading, into USD, into USD JPY, into Euro USD, into gold. That's what you want to know. But then there is something that all of this is leading towards that. Okay, so let's keep going. Now, USD index, USD and index trading. Okay, so what's this? Now, whenever the Federal Reserve increases interest rates, what's going to happen is that the dollar is going to appreciate. The dollar has been was the strongest performing currency last year. From March all the way to October, the dollar was just buying, it was just going up. And so at that time, I was trading, I would trade USD JPY. USD JPY, there was a time when it was predictable last year. Just buy, anywhere, just buy. Once you buy, you will make money. Just buy. This was somewhere around September, around June, July, August, September. Anywhere, just if you come into the market and you just click buy on USD JPY, you will make money. At the end of 1 month, in fact, just buy and go away. At the end of 1 month, you'll be making money. That was how it was, because the dollar was just going in one direction, which was up. The dollar was just going. And why was the dollar going in one direction? Because the Federal Reserve was increasing rates, interest rates. They were hiking rates, hiking interest rates. You see why I say that understanding all these things we are saying is very important in making money in the markets? So if you know now, if you know what the Federal Reserve is going to do, now the next FOMC meeting, FOMC is Federal Open Market Committee meeting. That is the meeting that the Federal Reserve has every few months. They have it about probably they have it about 9 or 10 times a year. The first one for the year is happening in February 3rd. So now, right now, as of now, you can know what is going to happen. You can have an idea that, okay, if the Federal Reserve increases interest rate by 0.25%, what's going to happen? Is dollar going to buy or is dollar going to sell? You can know what's going to happen there. That's why all this is important. So if you know that, okay, FOMC is happening, if FOMC is happening on the 3rd of February, what am I expecting? So you are just waiting. Let them say, oh, interest rates are increasing. If interest rates increase, you know that just go and buy USD JPY, you make money. You sell Euro USD, you make money. You sell gold, you make money. You see? So it's important. This is the reason why we go fundamental. That's the reason why we go into fundamental analysis and we follow and we try to understand what's going on, what news is coming out, what event is happening, what's the Federal Reserve doing, what is this doing, what's the other one doing. The reason why we are following these things is they are not for nothing. What is inflation doing? Is inflation high or is inflation low? Inflation high or inflation low can make you a lot of money if you know. Okay, if you know what inflation is doing, it can make you a lot of money. The day that the market is releasing, for example, on the 12th of January, which is probably next week, towards the end of next week, I think, I think Thursday or so next week, there's going to be inflation report coming from the US. That inflation is called CPI. If you go to investing.com or you go to Forest Factory, you're going to see CPI reports. CPI, core CPI, right? That CPI you're seeing there is inflation. That whatever report, whatever comes out that day, whatever number is released that day, will make some people a lot of money. If you know what you are doing and you are following it, you will make a lot of money from it, right? That is exactly how it is. You see, so that's why you understand if you want and why are you making money? You're not from that particular event. You don't even need to do analysis. You don't even need to do analysis. All you need to do is know what is the report that is coming out. Is it buy or is it sell? You can make money whether it buys or sells. Right? So that's why it's very important to understand these global events that we're talking about. Because like I said earlier at the beginning, this does not play out all at once. It plays out in bits and pieces. It plays out one news after the other in a month. Like today now we have non-farm payroll. Yesterday we had ADP non-farm payroll. We had something else. On Wednesday, I think on Wednesday we had FOMC minutes. The minutes from the last meeting that they had, they read it on Wednesday, right? Now next week we have some other events. I was talking about CPI. Towards the end of next week we have CPI report coming out. But all of this is opportunities to make money. That is if you know. So if you don't know, you will just be there saying, oh, I need to do this analysis, I need to do that analysis. Analysis is wonderful. But what I'm telling you is that beyond your technical analysis, beyond your 5 minute, 10 minute, your 5 minute, 15 minute, 1 hour chart, there is something you need to look at that's bigger than that small chart you're saying. What's making that? Why is it today? If you go to USD JPY chart, you will notice that USD JPY broke out of a certain level on the 1 hour. It broke out of there. But when you go to the 15 minutes, when the news came out, when you go to the 4 hour, when the non-farm payroll came out, the thing literally reversed and started coming down. And as I'm talking right now, it's still crashing. Why is that happening? And that crash, if you were selling today, you just make money. You didn't even do any analysis. Yet you make more money. You could make more money than somebody that's been trading throughout this week, just because of one news event. You see? So that's why we are studying and talking about these things. So the dollar index is called the DXY. If you go to TradingView, you will see DXY. On some platforms, on like Vantage platform, you will see DXY there. You see dollar index and all that, right? So US dollar as base currency. So whenever the dollar is rising, you will see that USD JPY is going to be rising too. It's going to be buying. You see, when the dollar is rising, you see USD JPY, any currency that has dollar as the base currency, which means in this case you have dollar as the first currency. That's called the base currency. The first currency is the base. The second one is the quote currency, right? The base currency and the quote currency. So whenever the dollar is buying, and then you see any currency that has the USD as the base currency will be rising too. Whenever the dollar is falling, like today, any currency that has USD as base currency will be falling. So the dollar, this currency pair now will follow the direction of the dollar. And that's exactly what's happening now. Then as the dollar is falling today now, this currency that has, all the currencies that has USD as quote currency means that it's on the right-hand side, all of those will be buying. Once dollar is falling, those ones will be buying. Go to your chart now, you will see Euro USD have been buying for the past few hours. Then gold is XAU USD. So it's still a currency that has USD as its quote currency. So gold is a currency, is a commodity, but it's also an instrument that has USD as quote currency, right? So that's why when dollar is buying, gold will be selling. When dollar is selling, gold will be buying. When dollar is buying, gold will be selling. When dollar is selling, gold will be buying. Right now, as dollar is selling, go and check. You'll find out that gold is buying. But for the past few hours now, gold is buying, right? So all of this is very important for us to understand. That's the reason why we go through them. So now, if you're new on this platform, we have updates on this. So if you create an account, if you don't have an account on Vantage already and you are here, create an account and test these things out on demo. That's why we're also going to, for those who are not, there's some people here who are not on our group chat. There's some people who got this link from somebody else. Somebody sent them this link, right? So if you are here and you are not on the group chat, so you need to create an account. You need to create a Vantage account so you can be added to the group. So everybody here right now, who is on this, who came from the group, you know that you have an account with Vantage Markets, right? So, and the advantage of that is not you may just start by trading on demo. So all of these things we are talking about right now, we give updates on them. We tell them today, if you are on the group, you would have seen that the videos that I did concerning this events that happened today. All right. So earlier today, I did a video and I talked about what has been happening in the markets since the beginning of this week and what we are likely to see today and all that. All of that, we talked about them in the group. So if you're not in the group, it means that you probably don't have an account yet and you were invited externally. So what you just need to do to be added to that group, I'm not on the group. Okay, so if you're not on the group, how do we do this now? Okay, if you're not on the group, okay, if you're not on the group, send a message to the person who asked you to join this training. Okay? Okay, you have an account already. You are not on the group. Okay, in that case, how do you get to me? I would have liked you to get to me so that I can add you to the group since you have an account. How do I do that? Right? Okay. Oh boy. I would have said to send you my okay, how do you, hold on, let me pause this recording. Okay, hold on, let me finish this class. I'll attend to that, right? Let me finish this class, I'll attend to that. All right, so so that's it. Just hold on, please, I'll attend to that. All right, so if you have any questions, let's just